Finally, almost. A U.S. stimulus deal is all but done, and a Brexit deal appears to be within reach. But the one thing we know for sure is that we have a vaccine. This is Bloomberg Wall Street Week. I'm David Westin. This week, special contributor Larry Summers of Harvard.
We need to have an economy where the dominant theme is jobs trying to find workers, rather than a dominant theme being workers trying to find jobs.
Congressman Don Beyer of Virginia. Dr. Sheila Davis of Partners in Health.
COVID-19 has illuminated, I think, that in the U.S. we're really lacking a robust public health response.
Dr. Ofer Levy of Boston Children's Hospital. Rick Rieder of BlackRock.
Anybody who describes this Fed as hawkish is so misguided.
Former IBM CEO Sam Palmisano. And former Clinton economic advisor Laura Tyson of UC Berkeley. This week, things finally looked like they were coming together as Republicans and Democrats got over their 7 months of squabbling to say that they think they can agree on a fourth round of stimulus.
The bipartisan, bicameral agreement appears to be close at hand.
And Brexit negotiators said things were looking good for them as well, with only those pesky fish standing between them and a deal.
The UK's position is always that we want to keep talking if there's any chance of a deal. We've also got to be able to control our waters and our fishing rights. It's obviously also what people voted for.
But the one thing we know for certain is that the first vaccine has arrived, with people being inoculated all around the country, and a second vaccine is imminent.
America is one of the very first countries to roll out a safe and effective vaccine for this virus, and America has played a greater role than any other in getting the world to this point.
And it came none too soon, as the number of cases and hospitalizations continue to soar, with 300,000 Americans having died and 3,000 more dying every day. And what did the markets make of all this news? Well, by and large, it was a risk-on kind of week, led by equities, led by the S&P. Also followed up with commodities, which were really off to the races, led by oil, with copper just a short distance behind. And as far as the 10-year goes, well, it didn't go much of anywhere, but the yield curve did steepen to its most steep dimension since October of 2017. The one little cloud on the horizon might be the Dow Transports, which were down for a second week in a row. And to help us make sense of all this, welcome now Professor Laura Tyson. She is at the Haas School of Business at the University of California, Berkeley. She was the senior economic advisor to President Bill Clinton, and she is a senior advisor to RockCreek. Professor Tyson, welcome to Wall Street Week. Great to have you here. Give us your sense. We look at the markets to try to give us some indication of where the economy is. Are they giving us an accurate read? What are they telling us about the economy?
Well, I think one thing they're telling you is that there is an expectation that once the vaccine is rolled out and once it is absorbed into the system, maybe in the second half of 2021, we're set up for a strong recovery. So basically, right now, we're in a faltering or stall out phase because the stimulus measures have worn off, because there are lockdowns around the country because of the resurgence of COVID. So we're in for a rocky several months, I would say. But I think what the market is saying is we're set up for a pretty strong recovery thereafter. However, the other thing I want to point out is there have been many observations about this recovery being K-shaped. So one K is that the stock market has been much stronger than the real economy on almost any indicator that we have seen since this recession faltering recovery started. So the K is pretty obvious there. Part of that has to do with the K between manufacturing and services. This is a recession which was driven by the service sector. It is a recession where the manufacturing sector was never that hard hit and has recovered strongly. So basically, that's another K reflected in the stock market, because the other thing is, of course, the tremendous growth in digital business, and therefore all of the revenues going to the tech giants and to some of the smaller tech companies as well, but the tech firms have been very important in this. And finally, let me just indicate another K, and that's the K that I was thinking about, and that is between the higher wage groups, the upper income deciles, the lower wage growth groups, and the lower income deciles, because I do not think that strong recovery we're anticipating perhaps in the second half of the year, it's not going to bring along a lot of the people who've been devastated by this situation, because those low wage jobs in those small businesses and service sector entities, they are not going to come back, or they're not going to come back for a long time, if they come back at all.
So speaking of those, a lot of the news this week was about stimulus, on again, off again. It looks right now like we will get the bill. Maybe we'll have to wait a little longer for it. Is that going to help that lower leg of the K at all, or are we just trying to prevent permanent damage?
Well, I think we're trying to do two things. First of all, I think almost to call it a stimulus package at this point misses the reality that this is a relief package. This is a relief package for the millions of workers out of work, for the millions of families that face food insecurity, for the millions of families that are facing eviction notices. These are relief measures. Now, they're also in, as my understanding is, we're going to get another round of the small business loans, the pandemic loans, and I think that is very wise. It's going to be very important to make sure that those are allocated to the hardest hit businesses. Because if you look at the payroll protection plan loans of the past, they were not allocated as well as they might have been. A lot of businesses got money. They weren't going to lay workers off. They used it essentially to improve their balance sheets or to invest. The small firms in the very hardest hit sectors, regions of the country, many low-wage businesses, it was very hard for them to get access to those loans.
So as a practical matter, is there much that the Federal Reserve Board can do to help that lower leg of the K, briefly?
The Federal Reserve Board. So I think one of the things that may be discussed going forward, my understanding is, as of right now, the Treasury is pulling back from the allocation of funds to mobilize the Federal Reserve emergency lending measures to state and local governments and to businesses. Those were never designed to deal with very small businesses. There might be a way to do some of that in a reconfiguration with the Biden Treasury and the Federal Reserve. So I don't close out that as an option. In the meantime, the renewed PPP would go through the Small Business Administration, would go through the banks, but my understanding is, once again, they learn from the lessons of the past, and there's a significant chunk of money for CDFIs. There's a significant chunk of money to go to find low business, very small business borrowers.
So the ball is back in the fiscal court, I think it's fair to say. Thank you so much to Professor Laura Tyson. She's chair of the Haas School of Business at the University of California, Berkeley. Coming up, the Fed issued its last pronouncement of the year, and Rick Rieder of BlackRock is here to explain what it means for the markets.
When rates stay where they are, that is a direct injection of value into equities and allows companies to finance them for M&A, for CapEx, for R&D, et cetera. So the equity market's going to go higher. I'm pretty convinced of that.
This is Wall Street Week on Bloomberg.
The Federal Reserve is going to try and lower interest rates. That will help. That will bring some vigor back to the economy. But it can only be mended by an increasing willingness on the part of the public to buy goods, a general confidence in the system itself, and much of that has been eroded over a number of years.
That was PIMCO's Bill Gross back in 1990. The Federal Reserve met again this week, but gone are the days when it can restore vigor to the economy by cutting interest rates. Instead, Chair Jay Powell tried to restore that vigor by assuring the markets that the Fed would continue to buy bonds until the economy is substantially better than it is today. We asked Rick Rieder of BlackRock whether those words were likely to do the trick.
they're on a persistent movement to support the economy. I think there was a lot of analysis yesterday that said that the Fed was hawkish because they didn't increase the weighted average maturity, or they didn't actually increase the asset purchase program. Anybody who describes this Fed as hawkish is so misguided. This is a Fed that is just going to continue to be there and be as accommodative. They said they're going to continue the asset purchase program at least as large, both in treasuries and mortgages. By the way, I don't even think they need to increase mortgages at all. In fact, I think they could shrink them. But they're going to keep going, and they're going to be incredibly supportive of the new administration and fiscal stimulus from here.
So Rick, as I say, the message out of the Fed, I thought yesterday was, we think in 2021 it's going to start getting better, presumably in large part because of the vaccine, which we're hoping for so much. At the same time, there's a real divergence, maybe even a bifurcation in the marketplace, whether it's individuals or it's companies, between some people who are doing very, very well and some people who are doing very, very badly.
Yeah, I mean, David, you hit the nail on the head. Listen, but I think this is, what the central bank does is, its tools are blunt. And a lot of what happens is it lifts financial assets and it creates this bifurcation, as you described. And it doesn't, what the Fed can do is it sort of paves the runway for other policy to come in. Now you really need the fiscal. And the fiscal is where you can direct tax policy, where you can direct where the stimulus gets to, things like state and local, things like healthcare spending, education spending, et cetera, things that can actually close that gap. I mean, now we actually are going to get what I think, particularly when you think about Chair Yellen, I still call her Chair Yellen, the Treasury Secretary, and now you've got functionally two Fed chairs that are going to operate in concert with one another, and that's where you get really effective policy, when fiscal and monetary work hand in glove with one another.
So, Rick, you have two hats at BlackRock, both Chief Investment Officer for global fixed income, but also asset allocation. So put some money to work here. Given that situation, the way you view the world, what's going on, what you expect, where are the investment opportunities? Where is it smart to put money right now?
So it gets harder every day, but I don't know. I feel like coming in every year, it's always hard. So, but I think the equity market's going higher. I think when people look at, when the Fed says we'll keep interest rates down and we're going to leave them down for a long period of time, it makes where rates have gotten to. It doesn't make the Treasury market interesting. Doesn't make, as we said, the mortgage market interesting. When rates stay where they are, that is a direct injection of value into equities and allows companies to finance them for M&A, for CapEx, for R&D, et cetera. So the equity market's going to go higher. I'm pretty convinced of that. And then how do you create balance in the portfolio? I would argue hold some cash. Hold some of your government rate risk, your government, the government debt you own in TIPS to get some inflation protection, and then get yield into the portfolio. It's getting harder and harder to get yield, but the credit market, parts of the emerging markets, parts of the securitized market, get some yield, run a bit more cash because it's harder to hedge today given where rates are, and then own the equity market, because I think equities are going higher. I don't think you want to hear the story of why equities are fully valued. I think people who just do equities don't see fixed income and don't see the benefit getting to the equity. And I think equities have got some upside to them. Doesn't say we can't trade down for a period of time, but I think they're going higher.
What about within equities? Is it time to really make that big rotation away from some of the tech names that have done so well for the last year or two and into some of the more cyclicals if we're anticipating that vaccine?
So I think there's tech and there's tech. I mean, I think, like you say, some of the names, particularly big tech, has had a really, really good run. And I think about the story of 2020 was ride the coattails of big tech. I think they'll be fine. I think they should still be part of the portfolio, but not as much as they were. But I'm still a big believer. Things like software, semiconductors, things that are aligned with artificial intelligence, cloud, et cetera, data assimilation. You saw play out this week in a number of names that came to the market. I still like those names, but then I like, and take some of that big tech that we've rotated down, go into some of the cyclicals, which will continue to do well. And whether that's in manufacturing, housing, we talked about through home builders, home improvement. And, I actually think, post-vaccine, you're going to see things like leisure, gaming, that there's some real upside. So I do think taking some more cyclical risk and, riding the consumer, because I think the consumer is going to continue to be in good shape. So consumer durables are a winner. And I think, I'm not a big believer in there's a big value rotation. I'd rather buy the companies that are cyclically oriented and they'll participate in the upside. Some of those are value and some of those aren't.
That was Rick Rieder, CIO for Global Fixed Income and head of the Global Allocation Investment Team at BlackRock. Coming up, the vaccine is good news, but how good is it? And what do we need to do until everybody gets it?
You know, vaccines, I think we're very optimistic, but still best case scenario, we're a number of months away for having full coverage, certainly in the US, and globally we're even much further off, which is really alarming.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. This week, the first doses of the Pfizer-BioNTech vaccine were administered, with millions more to come. We asked one of those on the advisory panel recommending FDA approval, Dr. Ofer Levy of Boston Children's Hospital, how the distribution is going so far, including at his hospital.
As we all know, we're living in very remarkable times. A terrible pandemic, and then maybe light at the end of the tunnel in the form of these mRNA vaccines. And as you alluded to this past Thursday, I voted in favor, along with the other advisory committee members, of FDA's emergency use authorization. As you know, that EUA was granted for the Pfizer vaccine, and vaccine now has begun distribution across the United States. And to answer your question, yes, we at Boston Children's Hospital now have some doses of this vaccine, and I am scheduled to receive it myself tomorrow at 12:40 p.m.
Oh, that's interesting. One of my questions would be, are you meeting any resistance up at your hospital to people receiving the vaccine? Because we hear reports, some polls even across the country, that say some people are reluctant to take it.
Well, you know, these are very unsettling times. People are afraid. They're afraid for themselves. They're afraid for their families, for their loved ones. And it's really, really critical that we acknowledge those fears, but that also we separate the emotions from the science. And the science shows that this vaccine, the Pfizer vaccine, demonstrated safety and efficacy in preventing COVID disease in those who received the two-dose series.
Doctor, I wonder, as we talk about schools or about your hospital, as more and more people get the vaccine, does it change your protocols at all? Because certainly it will protect, we assume, and we hope, the person who's inoculated. But does it mean that they don't have to wear personal protective equipment? Does it mean they don't have to socially distance or wear masks otherwise?
No, it does not. It does not mean that at this point. We're still trying to figure out. So we know that those who get the two-dose series of the Pfizer vaccine, for example, the vaccine is excellent, 95% efficacy, meaning you reduce your risk of getting COVID disease by 95%, a huge win. We still don't know for the Pfizer vaccine whether it reduces the risk that you pass on the virus to somebody else. And so those studies are ongoing, and we'll learn more in the weeks to months ahead. For the Moderna vaccine, I've looked at the briefing documents. They're publicly available now. Your viewers can download them online as PDFs from the FDA website. But there, some information was provided that not only does the vaccine greatly reduce the risk of COVID disease, it also appears to reduce the risk of asymptomatic infection, just having the virus without any symptoms, and therefore may reduce the risk that you pass the virus on to somebody else. That part of the study was limited, but was very interesting data, and much more to learn about these vaccines and whether they'll be able to reduce the spread of virus. But they certainly greatly reduce the risk of the individual who got the vaccine series from getting COVID disease, which is important.
That was Dr. Ofer Levy of Boston Children's Hospital. Because we don't know whether the vaccine will be effective at stopping transmission of the disease, we're going to have to keep up social distancing and mask wearing and testing and tracing. That's something the Partners in Health has been leading the way on, as explained by its CEO, Dr. Sheila Davis.
You know, vaccines, I think we're very optimistic, but still best case scenario, we're a number of months away for having full coverage, certainly in the US, and globally we're even much further off, which is really alarming.
So that does raise the question, how do we get from here to there? Because we have a real crisis on our hands right now. Give us a sense of what you are doing at Partners in Health.
Yeah, in the U.S., we've been working closely, certainly in the state of Massachusetts at the invitation of Governor Baker, and then in 11 other jurisdictions in the U.S. who have asked us to come in and help. And we've taken lessons learned from our work around the world in Haiti and Sierra Leone and other places on how to actually do contact tracing as one piece of a comprehensive plan. We really need a strong public health system, and this COVID-19 has illuminated, I think, that in the U.S. we're really lacking a robust public health response.
We've seen the testing ramp up from very, very modest origins, and now it seems to be moving along in most of the United States. At the same time, I wonder about the tracing part of it, because I know you're very involved in that. We have reports, for example, out of New Jersey, for example, where we had reports from Governor Murphy that maybe 70% of the people contacted don't comply, don't cooperate in helping with the tracing.
You know, I think what we've found is that when we're able to also assess what their needs are, a lot of people are not able to isolate or quarantine safely if they don't have the social support that's needed. People need diapers, people need formula, people need food. So a core component of what we embedded in the Massachusetts program, as well as with other places we're working, is that there's a direct connection to when our contact tracers reach out, which is the advantage of versus a text or some other type of tech option, and assessing, do people need help? Do they need a place to stay where they can safely isolate from their family members? So it really is, it has to be more of a safety net model. So I think most people do want to comply, but many people don't have the ability to have a separate wing in their home or a separate way to have food brought in.
That was Dr. Sheila Davis, CEO of Partners in Health. And now it's time for a look at the week ahead for Global Wall Street.
David, as we round out the year, Asian central banks remain in the spotlight next week after several stayed on hold amid bets for a post-pandemic recovery. In China, the PBOC likely to keep loan prime rates steady at the last fixing of the year as it seeks to gradually normalize policy and rein in credit growth. The Bank of Thailand also up to bat and no change expected, but measures may be announced to cool the baht's rally, although it is harder for authorities to intervene as aggressively after the country was added to the Treasury's currency manipulator list. Danny?
Thanks, Sophie. Really, over the next week, the most important thing, and has been for the last week, is what happens with Brexit trade negotiations. A serious situation, blocked, running out of time. Those are all the phrases we've heard describe the current state of play. Now, the pound rallied pretty significantly last week on hopes that we would get a trade deal reached, but fishing remains the key issue. Will that get hammered out this week? That's going to be the most important thing for sterling. Scarlett?
Thanks, Danny. You could say Tesla becomes a blue chip stock next week, and that's because starting Monday, Tesla will be the newest member of the S&P 500 index. The electric vehicle maker has seen its stock jump almost 700% this year, inflating its market value to more than $600 billion. That'll make Tesla the sixth biggest company in the benchmark index. The inclusion also means that the roughly $4.7 trillion of funds that track the S&P 500 will have to buy Tesla stock as well, giving it a solid base of support. Now, because of the holiday-shortened trading week, the economic calendar is pretty full, including a final read on third quarter GDP, consumer confidence, and sales of previously owned homes. David?
Thanks to Sophie, Danny, and Scarlett. Coming up, a major cyber attack on the U.S. government, pointing out once again how vulnerable we are. Something that Sam Palmisano, the former head of IBM, knows about.
I think it does wake the nation up to the risk we face if we don't do something about our cybersecurity and our infrastructure.
This is Wall Street Week on Bloomberg.
To truly make America safe, we must make cybersecurity a major priority, which I don't believe we're doing right now.
It was a priority of the Trump administration, which created America's first cybersecurity agency and gave it $2 billion to fight off cyber threats in fiscal 2020.
His own cybersecurity chief overseeing this election said it was the most secure in American history.
And while it was successful keeping foreign actors out of the election, cyber attacks are still rampant. Just this week, it emerged that Russia-backed hackers gained access to U.S. government agencies, including Homeland Security and Treasury, and potentially many U.S. companies.
This is a cyber attack like none other that we have worked in the past. And this is potentially dating back as early as March 2020, which means they had unfettered access for months.
With the White House holding daily meetings on the hack, the extent of the damage is still unknown.
Many people think I have to eliminate risk. I have to eliminate the security threat. You can't. Even if you stay in bed all day, there's a risk the ceiling will fall down on you. You have to manage the risk, and that means you need to understand what is a tolerable level of risk and consequence, and then what is on the other side of the balance, what are you prepared to spend to lower that? And then where those two lines cross, that is where you want to manage risk.
But if you're going to manage the cyber risk, it starts with knowing where it came from. Sam Palmisano ran IBM and served as the vice chairman of President Obama's Commission on Cybersecurity. He says his first reaction to the latest hack was to question even whether it came from the Russians.
My first reaction when I heard about it, quite honestly, I thought it was the Chinese. And I'll tell you why I say that. Because if you look at the historic pattern of the various types of attacks that have occurred in the past, this is more like the Chinese trying to get access to information and data, and then the Russians had their own strategies. And we can talk about, election interference and the like, as well as in the financial side of transactions. So, however, obviously that's not the case. I mean, this time it was the Russians and whatever they call themselves, Cozy Bear or APT-29, whatever it happens to be. I think that from what I've read and what I hear from my friends in the government, that they're pretty confident that's who it was this time. Now, having said all that, I mean, I think it does wake the nation up to the risk we faced if we don't do something about our cybersecurity and our infrastructures.
So how does this happen, Sam? I mean, for those of us who don't understand this world the way you do, this is not the first hack we've heard about, either of government computers or often of private sector computers. And yet it seems it was quite vulnerable. This organization, SolarWinds, a private company, has something like 275 or 300,000 different customers. About 18,000, they say, may have been affected here. But it included things like the Treasury Department and the State Department and the Department of Homeland Security, the IRS. How can we be that vulnerable at this point?
Well, I mean, actually, David, if you kind of stand back from this hack, and there's a pattern of this. In fact, we studied this in the Obama Commission, and my as you mentioned, my think tank is focused on this as well. Think about it as your supply chain. In this particular case, SolarWinds is a provider of services, network services, but services to all these various entities. That's the nature of their business. However, they're very innovative. They're very good. They're growing very, very quickly. But perhaps they weren't as thorough as they needed to be as far as securing their particular platform itself. I don't know that, but the suspicion is that they were able to get in, the hackers were able to get in and through what they would call a backdoor or a vulnerability. And then through that vulnerability, they were in there for a long time. And that's where they go undetected, which is the complexity of trying to figure out how this happened and who they are and what the impact is, because they've been kind of invisible. Then all of a sudden something happens where they become apparent. Either a big data set start to disappear or whatever that happens to be, or the government sees what's going on and they have to begin to react. But the point of it is that the key is the vulnerability of people's supply chains. I mean, if you were going to go hack the US government, you wouldn't go hack the military or NSA or CIA. You would hack the civilian side of government, which is not nearly as secure, coming through one of their providers, their service providers. No different than if you're going to hack a bank. I mean, to go after a bank that's spending billions of dollars or hundreds of millions of dollars to protect their infrastructure is very challenging. However, if you go through someone within their supply chain, some small innovative company that they're using to either help with technology or just sell their products and those sorts of things, they're the ones that are the most vulnerable, and then therefore your entity is vulnerable because they're part of your operations.
We have President-elect Biden coming to office January 20. Who does he have responsible for this? Or who does the current president, President Trump, have responsible for this? Who does he call up when he hears about something like this?
Well, that is a great question, my friend. That is unbelievably a great question. I would say they should start with somebody within the White House staff, but let's talk about it as it is today versus as maybe a point of view as it should be. As it is today, there is an agency called the Cybersecurity and Infrastructure Security Agency. It's part of the Department of Homeland Security that is responsible for these kinds of hacks, for agency protection, pandemics, all sorts of things, but they are the responsible agency that does these things. As you might recall, there's nobody leading that agency at this point in time because they were all fired. So there's no one in the agency at the agency level who is in charge of leading these operations. There's also no one in the White House staff either, by the way, because as it was part of the focus in the National Security Council and the Obama administration, we proposed in the executive order that they elevate it to establish a higher set of priorities. That would be a visible way to create priority within the government, is elevate that person or that individual. Since then, that actually has been kind of lessened. Their responsibilities have been lessened, and therefore, obviously, their focus and their impact has been lessened. So if I'm the president of the United States, sitting president of the United States, and I wanted to call somebody from my staff in my office to tell me, hey, what's going on? What should we be doing? There's no one there.
No, I was going to say, you have written that we are at cyber war right now. We just don't seem to recognize it. The problem, though, is going back to the very beginning, how do you conduct a war if you're not sure who actually fired the shot at you? Because even here you say you thought it might be the Chinese, maybe it's the Russians.
And that's the challenge, because it's very difficult to know where all these attacks are coming from. I mean, you can talk about in the private sector, the famous one was the Sony attack. And it took a long time to figure out whether it was North Korea or who helped North Korea. Was that really Iran or was it the Chinese? And that takes a long time because of the nature of how you can hide within the internet, let's say, in layman's terms, and then get yourself embedded into the infrastructure. The key to doing that, though, is quite honestly, you need to be protective and also have a mechanism in place to respond. So you have to plan. If you're the government or a company, you have to plan, assuming even though you take all these precautions and maybe you're best of breed, something's going to go wrong, and you have to have a response mechanism in place.
That was Sam Palmisano, former chairman and CEO of IBM. Coming up, it seems to be all over but the shouting, as congressional leadership says it's on the cusp of that fiscal stimulus that's been 7 months in the making. We talk with Democratic Congressman Don Beyer of Virginia about the compromise.
No, it's not enough, but once again, this is the art of the possible.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Congressional Democrats have been trying since last May to get a fourth round of fiscal stimulus, but until this week, they could not get enough Republicans to join them. That changed when a bipartisan group of senators proposed simply taking out the two controversial provisions that had been holding them back. Democratic Congressman Don Beyer of Virginia says it's not ideal, but it is better than nothing.
This is the most optimistic I've been in 6 months, David. It looks like the big hangups have been, as Democrats, we really wanted more money for state and local governments. They've laid off 1 million workers, but the Republicans really wanted this gross negligence shield for liability for companies, and there was just no way of getting over it. So they pulled those two out, put them in a separate bill. It's not clear that we'll even vote on that bill. But what's left is about $900 billion, including more money for the unemployed, $300 a week for the next 10 weeks, and another $600 check for people below a certain income level, and probably most importantly, a big chunk of money for vaccines.
So in the nature of a compromise, you don't get everything you want. It sounds like both sides are not getting something that they wanted. Is it enough? And particularly, is it enough for the workers, for the people around the country who are really facing food insecurity, housing insecurity, a lot of risk, and small businesses, goodness knows. I mean, you're a businessman yourself. You built your own business. Is it enough?
I don't think it is. In fact, you look at the initial claims this morning that jumped up to 885,000. And that was, supposedly seasonally adjusted. So we're looking for unemployment, new claims in January, more than 1 million a week. And that's a level we haven't hit since last May. So, no, it's not enough. But once again, this is the art of the possible. And we're going to hit another cliff in 10 weeks when we have a lot of people still unemployed and the unemployment insurance has gone away.
Which raises the question, Congressman, do you anticipate the need to come back for more stimulus, perhaps, fiscal stimulus, in the new year with the new Congress?
I absolutely do. Because I think part of our optimism, and it may be misplaced optimism, is that with Joe Biden in place, and we see what happens in those Georgia Senate elections, that we get another bite at the apple. And we're also very much hoping that the Republican governors and mayors and county board members finally start beating up the Republican senators about getting money for state and local governments.
As you look at the need to build back better, is I think the way President-elect Biden is putting it right now. In the Biden administration, how do you think it's going to be different than managing the economy? What do you look forward to?
I think the biggest thing will be, if we look backwards, and maybe not everybody wants to hear this, but there's a great Bloomberg piece just published last night, a couple of British economists that looked at 35 different countries and whether cutting taxes stimulated economic growth. And their conclusion was absolutely not. And we saw that huge $2 trillion Tax Cut and Jobs Act, and the economy kept growing at the same rate it was before and the same rate basically that it did until the coronavirus. So I think we're going to have a much greater emphasis on investment. So think a big infrastructure package, more money for education, especially those folks who've been left out of the economy, high school education or less. And I'm hoping a much more expansive trade policy that depends less on tariffs and more on new agreements with Europe, with Pacific Rim nations, folks like that.
If the tax cuts may have been a mistake at the time, in retrospect, does that mean in this economy, given the perilous situation, it makes sense to actually reverse some of those and increase some taxes to pay for some of that investment?
No, I think we'll be very reluctant to do that in the short run or even in the middle run. You're right. With maybe 30 million people unemployed, even if we can argue that the 21% corporate tax rate was way too low, I think we're going to be very reluctant to move it back to 27 or 28 until the economy is really moving again. I think most of us think that the austerity measures of 2011 were premature. The austerity measures going back before we were born in 36, 37 were premature. Let's make sure that we're moving back towards full employment before we start thinking about reining in the deficit. Interest rates are close to zero and will be for the foreseeable future. We can afford this in the middle term.
That was Congressman Don Beyer of Virginia. Coming up, we wrap up our week with special contributor Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. As we do every week, we conclude our week with Larry Summers, our special contributor, former Treasury Secretary of Harvard. So, Larry, great to have you back with us. We finally are going to get that stimulus, about $900 billion. What do you make of it?
Better than the alternative. Good insurance against things going wrong. Glad to see more investments in testing. Really sorry to see that we're not supporting state and local governments. It's not a healthy thing that we couldn't reach some kind of compromise on the liability issue and the state and local government issue. That's really a very poor reflection on our system. And I'm not sure we needed an across-the-board set of checks for households at this date, given that the vaccine is on the way, given that there's very substantial accumulated savings in large parts of the household sector. So I'm glad to see that stimulus is coming. I'm glad to see help for small business. I'm glad to see continuation of unemployment insurance. But this is not as good a bill as we could have had. Still, it's better than I expected 2 weeks ago, and we should be grateful for that.
So pick up on your point about checks going to everybody, regardless of what their particular needs are or not. We heard from Chair Jay Powell of the Federal Reserve this week saying he thinks overall that the prospects are brightening for the U.S. economy in 2021. We have a rough patch to go through, but we do have a vaccine coming. But he also pointed out that really below that top line number, there are some people doing very, very well, whether it's individuals or corporations, and other people doing really not well at all. What can we do about that part of the problem?
Look, it's a K-shaped recovery. There's no question that for people who can sit in the solitary splendor of their homes, doing their work by Zoom, having their groceries delivered with more family around than usual, this has not been an agonizing period. For others who work with their hands, who are providing those deliveries, who don't have the kind of space to be fully safe and may not even have the kind of cash flow to be able to buy both their medicines and their food, it's been a very, very difficult period. This is why we need a more just and generous society. We need a stronger set of refundable tax credits, particularly the child care tax credit. Above all, though, we need to run this economy strong and have an economy where the dominant theme is jobs trying to find workers, rather than the dominant theme being workers trying to find jobs.
Larry, as you just laid out, the Biden administration, as it comes in next month, has a long list on its agenda economically for the United States. At the same time, I wonder about globally. Can we really succeed in the long term in the United States without having the global economy recover? What lessons are there from the pandemic for the global economy?
I used to say when I was Treasury Secretary that the world economy couldn't fly forever on a single American engine, or that no nation can be an oasis of prosperity in a troubled world. I think we're going to reap very substantial consequences from the fact that after decades, when developing countries were developing and were catching up with the world's major economies, that trend is going into reverse right now, given the difficulties they're having in managing COVID, managing reduced exports, managing heavy debts, managing reduced remittances. And we need to step up on that. We need to step up with very substantial global financial support provided through the international financial institutions. We need to step up with an SDR, special drawing right allocation from the IMF. We need to step up with much more investment in making sure that there's not another pandemic. And while we're at it, making sure that there really are the resources to get vaccine to all the people on the planet, not just the people in the rich countries, as quickly as possible. We've got two K-shaped recovery problems we need to fight. A K-shaped recovery problem in America and a K-shaped recovery problem globally. And ultimately, it's going to be cheaper for us to fight that fight, to support developing countries sooner rather than to support them later. And I hope that one of the first initiatives of the Biden administration will be bringing a global dimension to the COVID recovery effort.
We always like to end the week with a lightning round, as Summer says. Let's take three questions here. Number one, we heard Jay Powell, the chair of the Fed this week, say he's not going to back off bond buying until we really restore a lot of the employment. When are we going to be back to a 4% unemployment rate in this country?
End of 2022.
And what about inflation? He also talked about inflation. When will we be back over 2% inflation in the United States?
Sometime during 2022. We'll see at least several months because of some combination of specific factors where the inflation rate will get above 2%, would be my guess. I think that may come sooner than people think.
And Larry, finally, we've seen yet again the markets really hold up no matter what's going on with respect to COVID-19 as it spreads rapidly throughout the country. Are the markets, the equity markets in particular, are they justified right now? Are they priced about right? Are they overpriced? Where do you think they are?
Many people think they're overpriced because they look at a very strong, very high price-earnings ratio. I think that the kind of analysis that Chairman Powell offered in his testimony on Wednesday was right when he emphasized that you have to look at price-earnings ratios in the context of real interest rates, and that with real interest rates low for what I think are quite deep-seated structural reasons, my guess is that you're going to see markets priced not unreasonably. That doesn't mean they're going to keep going up as fast as they have in the last 6 months, but I don't have a sense of extremely precarious bubble.
What does that do to price discovery in the equity markets as a practical matter? Because the low interest rates are true for everybody, whether you're a well-run company or a poorly run company. Are we sustaining sometimes they call them zombie companies who don't have enough EBITDA to really service the debt? Is there a risk here to the economy in the long run that we don't have price discovery really sorting out the sheep from the goats, if I can put it that way, in corporations?
There may be a bit of that, David, but I actually think the larger effect is probably that low interest rates mean lower discounting of the future. And so everybody's encouraged to take a longer view in their economic decision making. And it's that forward-looking activity that's most likely to deliver large external benefits to the economy. So I think one should see these low interest rates more as an opportunity than as a burden.
Okay, Larry Summers, it's always a delight to end the week with you. That is our special contributor, Larry Summers, former Treasury Secretary of Harvard. Finally, one more thought. All of us are sick and tired of the restrictions being put on us by this pandemic. The masks, the social distancing, the canceling of travel plans, the being away from loved ones at the time of the holidays. And all we seem to hear from our officials are what we can't do.
To the extent possible, don't travel, don't congregate together. I know how difficult that is. We all have a strong degree of empathy, knowing, and myself included, about wanting to be with your family, wanting to have a large Christmas dinner with family and friends over. Right now, that just should not be done.
And where we can't go.
We're going to close indoor dining in New York City on Monday. Outdoor dining and takeout continues.
But one adventurous soul took it to a whole new level. When denied permission to go visit his girlfriend in the Isle of Man, he bought a jet ski in Scotland and rode it for 4.5 hours over the ocean to join her. The only problem was the officials found out about it, and now he's spending 8 weeks in jail instead of with his girlfriend. But he's not the only one to have been caught by these pandemic restrictions. The Prime Minister of Japan had admonished people not to have year-end celebratory get-togethers, and then he promptly went to several of them himself. And the governor of California, Gavin Newsom, was caught indoors at the upscale French Laundry restaurant in Napa Valley, attending a birthday party for a lobbyist friend.
The spirit of what I'm preaching all the time was contradicted, and I got to own that. And so I want to apologize to you because I need to preach and practice, not just preach and not practice.
Yes, we're all sick and tired of it. We are all tempted to bend or even break the rules. But before we do, let's give a thought to who might be watching us. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.